remarks by the leadership of the association. So we'll take that and then we'll go into the main reason why we're here. Thank you.
Thank you, Chinyere. Ladies and hopefully gentlemen, at least our speaker is a man, so I'll just say, ladies and gentlemen, I don't know if there's any other man in our midst. Please feel free to drop on the chat box where you're joining us from. So I am Uju Onyepere, the Deputy Chair of ACCA Women's Network. On behalf of our convener and chair, Mrs. Victoria Abiola Ajayi, I welcome you all to today's learning session. This learning session is aimed to help us, get us prepared. Like the Boy Scouts will always say, be prepared. So we want our members and even non-members joining us today to prepare for the change that is coming. It's actually a very big change that is coming come January 1st. A lot of things is going to change in the tax landscape. And we are quite privileged to have in our midst somebody that Chinyere will soon introduce, that is a seasoned tax advisor with deep understanding of Nigerian tax matters. So he'll be taking us through this. And what makes this session quite unique is the fact that we'll have time to take our questions. I'm sure many of us might have had the opportunity to attend some other learning sessions that has happened, but this one, it's a closer one where we'll have the time to ask all of our questions. So please, I urge you to listen in and drop your questions. We'll have time to take all of the questions, hopefully. So please, let's make very good use of this opportunity. Now, let me speak a little bit about ACCA Women's Network. So we are over 280 ACCA women qualified accountants of Nigeria origin in this network. We turned 5 earlier this year, so we were founded in 2020. So since then, all we have aimed to do is to provide a platform to be a community for women accountants to support one another on this career journey. And we've recorded some successes so far. And so this event is one of the ways that we try to add value to the society. We have our networking sessions, we have training, we have coaching, we have advocacy, and we also try to give back to the society through some of our outreaches to schools and to the less privileged ones. So we are glad to have you here this morning. I will be adding value to you via this session. So please stay tuned. Thank you, and back to you, Chinyere.
Thank you very much, Uju. So very quickly, I'll be introducing our speaker for today. So, can you hear me?
Yes.
Yes.
Okay. We have with us today someone who's an authority in tax matters, Vincent Okoukoni, who also happens to be a member of the association ACCA. Vincent Okoukoni is a senior manager in the commercial practice group at Andersen, with over 11 years of experience in tax practice. Prior to joining Andersen, Vincent spent over 6 years in Deloitte, where he provided tax compliance and advisory services to several clients in consumer markets and financial services industry. Vincent has developed a very strong relationship with tax authorities and has assisted several of his clients in resolving tax disputes, ranging from desk reviews and tax audits to tax investigation exercises. He has led several projects on tax compliance and advisory, tax risk assessment, and tax due diligence. He has also assisted several local and multinational companies in reviewing transaction taxes, as well as providing advice on tax implications of several business decisions. He also facilitates tax training programs for clients and tax practitioners. And he is specialized in tax compliance, tax advisory, and tax dispute resolution. I'm sure we couldn't have had anyone better to take us through this session. Please join me in giving a warm welcome as I hand over to Vincent to take us through the next session. Thank you.
Good morning from Lagos. I understand that we may have joiners from all over. We'll have joiners from all over the world, actually. So, what is it's morning over here in Lagos. I'm just trying to turn on my camera if you can. Okay. Good morning, everyone. Thank you for joining. So let's get right into it. Of course, I believe a number of us are aware of the changes that have been introduced by the tax reforms. I wanted to say Finance Act, because over the years it has been a sort of an annual ritual where on an annual basis the laws are amended and fine-tuned, just to get up to speed with current realities and to align Nigeria's tax system with global best practices as it were. But what you have with the reforms is a complete overhaul, not just a change, not just a fine-tuning. It's a complete overhaul of the existing tax system, and then it's a total change from what it used to be. So at this session today, the intention is to look at some of these key changes. We'll try to discuss the industries or the businesses that would be affected, how those changes would affect those industries and those businesses. And we'll try to look at perhaps some practical insights as we go on. So I'm sharing my screen right now. Okay, please let me know if you can see my screen.
Yes, we can.
All right, thank you very much. Okay, so um, I've tried to put up like a guideline for how the session will look at. So I mentioned we'll look at the Reform Act, a quick overview of the four acts. We'll take a look at the business insights and implications of those changes, some industry insights, and then we take some questions and answers to hopefully drive home the point. Okay, so with the Reform Act, like I said, this is different from the practice of having finance acts on a yearly basis, at least for the past 4 years or thereabouts. But instead, now we have a complete overhaul, and that overhaul has come in the form of four new tax, acts. Perhaps the most popular one is the Nigeria Tax Act, because that's the one that really talks about the tax laws, the tax implications, tax treatments of transactions. And what that has done, basically, what the Nigeria Tax Act has done is to more or less consolidate all the tax laws into a single framework. Of course, well, I wanted to say before now, but currently we have different acts. So there's the Companies Income Tax Act that talks about, how companies should be assessed to income tax. There's a Value Tax Act that talks about, VAT rates, transactions, and whatnot. You have the Personal Income Tax Act that talks about, taxing individuals and earnings from employment income and self-employment. You have the Capital Gains Tax Act and a host of others. But with the Nigeria Tax Act, instead of having different acts, that to address different taxes, we now have just one single act that addresses all these taxes. So we're no longer going to have the Companies Income Tax Act, Personal Income Tax Act, that fragmentation will no longer be there. Instead, we have just one Nigeria Tax Act that combines and consolidates, all the tax laws into one single framework. There's also the Joint Revenue Board Establishment Act, which basically focuses on, providing harmonization of all revenue administration, activities in Nigeria. Because we've seen instances where, so a quick example, there's the Federal Inland Revenue Service that collects taxes due to the federal government. And of course, we have state internal revenue services that collect taxes due to state governments. we've seen instances where there could be, certain clashes, overlaps, duplication of efforts, and questions around who has right authority to tax. And some of those conflicts are evident when there are tax audits in terms of tax queries being issued by the tax authorities. So what this will do, what is expected to do, is to provide some sort of equalization and handshake between or amongst tax authorities, so that the overall objective of revenue administration will be streamlined, and it will be easier to handle and resolve tax disputes. Okay, so there's the Nigeria Tax Administration Act as well, which basically establishes a framework for managing taxes and revenue, while also, ensuring compliance and also trying to reduce, ambiguities. And then finally, there's the Nigeria Revenue Service Establishment Act of 2025. What this has basically done is to rebrand FIRS. So currently, Federal Inland Revenue Service (FIRS) is the chief collector of taxes in Nigeria, but then the functions of FIRS, would now be extended, to cover basically all revenue due to the federal government, including, some that were previously collected or that are currently being collected by Nigerian Customs Service, for example. So instead of having just Federal Inland Revenue Service, it will now be known as the Nigeria Revenue Service. And the objective or the scope of its activities in terms of revenue collection will now extend, beyond more than just tax, and to collect other levies previously collected by the Nigerian Customs Services. Okay, so of course these laws were signed at the end of June by the president, and then since then there have been, of course, commentaries on how these new laws affect businesses. There have also been the gazetted copies have also been issued, to give effect to it. But I am also aware that there are certain conversations that are ongoing in terms of, making some tweaks and fine-tuning to the laws as we have them. So we'll watch out for that. And of course, if and whenever those changes are made, we'll also look at the impacts and see what exactly they mean for businesses. Okay, so some quick objectives of the reforms, taking everything together. Of course, the first is to consolidate the existing tax laws, which we find within the Nigeria Tax Act. One of the objectives is to try to enhance compliance by simplifying processes, reducing burden for taxpayers. I mean, basically trying to make it attractive and encourage compliance. So if a business has to pay, say 5 different types of taxes, for example, and if you're able to reduce it to just two types of taxes, that would make sense. If there were 7 or 8 levels when it came to filing of tax returns and making tax payments, and if there's a way that can be streamlined to make it just 1 or 2 processes or 2 activities, that would also be music to the ears of taxpayers. So it's supposed to. It is hoped that this will also encourage tax compliance, apart from consolidating all the existing laws. There's the objective of expanding the tax base, which is to, of course, like we've heard too many times already, expanding the tax base, expanding the tax net, bringing more persons into the tax net. And of course, this is hoped that it will, broaden the range of taxable activities. And of course, this will increase the number of individuals and businesses that will pay their taxes promptly to the government as and when due. There's also the objective of course, generating revenue for the government. Tax is a major source of revenue for the government, of course, like we know too well. It is hoped that, or one of the objectives is that, these new reforms would, increase government revenue and make funds available for development and capital projects. There's a thought to improve tax equity. If you look at, by the time we dive deep into some of the reforms that have been introduced, of course there are some parts that businesses I've spoken to are quite happy about. where it will mean an overall reduction in their tax bill. But of course, you would imagine that there are other areas where that would appear to maybe favor the government more than the taxpayer until further clarity is provided. There's also the thought of modernizing administration through digitalization. I want to believe most of us have heard about e-invoicing, for example. The idea is to use technology to enhance overall compliance and tax administration processes. But of course, there are concerns around things like data integrity, theft of information, and all of those. We'll get through to it as the session progresses. Okay, so some of the key changes in the Nigeria Tax Act, because I mean, like I said, that's the chief amendment or reform in all of the new acts that have been introduced. This is the biggest of them all in terms of what it affects. So the first point I want to talk about here is the definition, or in fact, redefinition of small companies. So before now, the definition of a small company prior to 2019 Finance Act, a small company was more or less a company that had less than 1 million naira turnover. But of course, times have moved on since then. And then when the Finance Act 2019 came on board in January 2020, that definition, or rather the threshold for small companies was increased to 25 million naira. So a company having less than 25 million naira was termed or classified as a small company. And that meant such a company will not pay income tax. And of course, they were also exempt from collecting and remitting value-added tax. And the idea of that was to, not overburden small companies because they needed time to blossom and, grow into a really profitable business before the government starts demanding taxes from them. Now, with the Nigeria Tax Act, a small company has been redefined, especially with turnover threshold. So the turnover threshold has, gone from 25 million to 50 million. And that is also supposed to, reflect current economic realities. So a company that earns gross turnover of 50 million or less, per annum will be classified as a small company. But in addition to the revenue threshold, there's also a new introduction of what I call asset threshold, meaning your revenue is less than 25 million naira annually, but the total fixed asset that you've employed in your business also does not exceed 250 million naira. Now, this is entirely new from what we used to have. But of course, they then put a caveat or a clause there to say that companies providing professional services will not be classified as a small company, irrespective of, the thresholds for revenue and for assets. So what that means now is that for a small company with turnover of less than 50 million and fixed asset not exceeding 250 million, provided it's not a professional service firm, it will not pay income tax, meaning the income tax rate is 0%. And then for every other company that has more than 50 million turnover, gross turnover, it will pay income tax at 30%. Now, one of the key changes here is that before now, with Finance Act 2019, we used to have medium-sized companies. So it was small company with less than 25 million turnover, medium-sized companies that had between 25 million and 100, but less than 100 million. And then we had large companies that had 100 million turnover and above. So then small companies were still at 0%. The medium-sized companies that between 25 and 100 million, they were taxed at 20%. And then large companies with more than 100 million turnover, they were taxed at 30%. But now that categorization that has to do with medium-sized companies has been wiped out completely. So we really have now two categories: small companies and others. So every company that is not a small company will be taxed at 30% on total profits. So it is expected that this would again reduce the tax burden on small and micro-sized businesses, because the idea, like I mentioned, is to give them some time to grow their business into a really profitable one before they start paying taxes. But of course, it will mean that companies that used to be categorized as medium-sized companies having turnover of between 25 and 100 million and paying tax at 20%, will now be exposed to higher income tax rate because that category of medium-sized company has since been eliminated, and then it means that they will have to now pay tax at 30% once they exceed turnover of 50 million. Okay. So another key change that was introduced is a new development levy. Now, currently we have a lot of taxes and levies that are based on different aspects. So there's the income tax that is based on total profits. There's the education tax, tertiary education tax that is based on accessible profits. There's the police trust fund levy that is based on profit before tax. There's the NIDA levy, information technology development, that is based on profit before tax. And there's NASENI, National Agency for Science and Engineering, that is also based on profit before tax. So you have all of these different taxes and levies with a different tax base. Now, what the government is trying to do is to say, instead of having all these, fragmented taxes, why not have okay. I will get to your question, UGN Consulting. So instead of having all this fragmentation, why not have a single levy that will sort of consolidate all these existing different levies, into one? So instead of having the tertiary education tax, which is currently assessed at 3% of accessible profits, NIDA levy at 1% of profit before tax, provided you have a turnover of 100 million, NASENI at 0.25% of profit before tax, police levy at 0.005% of net profits. So if you take all of this together, you have about 4.255% as the effective tax rate for all of these levies. But then the government is saying, rather than have all of these, let's have a single levy that will be applied at 4% on accessible profits. So what this will mean for different companies in terms of all these fragmented taxes is that for financial services companies like banks especially, so like I said, these banks used to pay all of these, would have come to about 4.255%. So what it will mean is that with this introduction of 4%, it means that banks and perhaps other financial institutions will be paying less. So there will be a saving of about 0.255%, and because now they're moving from 4%, 4.255% to 4%. So it will mean a slight reduction in the taxes or levies they pay potentially because of the slight reduction in rates. But for manufacturing companies particularly, this is an overall increase in their tax bill because currently manufacturing companies do not pay NIDA and they do not pay NASENI, for example. So manufacturing companies will only pay education tax, which is 3%, and police trust fund levy, which is 0.005% in any year where they have profit before tax. So what it means is that for manufacturing companies, they are going to be moving from 3.005% to 4%, which is an increase of almost 1% in levies that they are going to be paying as part of their taxes in any assessment year. While for financial services institutions, especially banks, there will be a slight reduction in the overall levy in terms of rates because they're moving from 4.255% to 4%. Okay, so back to let me quickly take the question that was asked by UGN Consulting. So for firms, of course, I think the distinction here will be very clear because you have firms that run as partnerships, and then companies that provide consulting services where it's a limited liability company. If it's a firm, a professional services firm that provides consulting and professional services, then this would not really affect because, it's still a partnership and it is the individual partners that will be required to, to account for taxes. This will affect professional service companies that are providing consulting services such that they're limited liability companies and they pay companies income tax to the FIRS. Professional services firms or partnerships do not pay CIT to the FIRS. So those will not be affected. This would affect professional company or consulting companies that are registered as limited liability companies who ordinarily pay, companies income tax to FIRS. I hope that is clear now. Please let me know if you need more. So Jimmy to speak more on that. Okay, so effective or minimum effective tax rate. Now, so in Nigeria, there's what is known as the minimum tax currently, which is levied when a company has no total profits, no tax payable, or where the tax it would ordinarily have paid is less than minimum tax. Now, minimum tax is currently assessed at 0.5% of gross turnover, less frank investment income. Now, there are, okay, thank you very much. So now there was of course, Nigeria model some of our tax conventions, especially when it comes to cross-border transactions after OECD recommendations and guidelines. Of course, this stems from the OECD Pillar 2 or two-pillar solution, where where they were signatories to a multilateral agreement that agrees that where a non-resident entity has some economic presence in a local jurisdiction, the tax it will pay will not be less than 15%. Now, so there's a threshold, and that has been captured in Section 57 of this Nigeria Tax Act, which introduces what is known as an effective minimum tax rate. And that would be applicable where a multinational enterprise or any other company that has an aggregate turnover of 20 billion, that if the effective tax rate of such a company is less than 15%, and then that company will now be required to recompute and pay an additional tax to, make up for the differential. So let's assume the entity has paid taxes and the effective tax rate is 12%, for example. What it means is that there has to be a recomputation that will now make the effective tax rate equal 15% by an addition of 3%. Now, one of the key, one of the things I struggle with when it comes to, this new provision is, so it talks about effective tax rate. Effective tax rate may be, depends on, because there are different components that go into, the calculation of effective tax rate, which is essentially, the rate of your tax expense to your, to your profit before tax. There would be, I feel like there are different peculiarities and there are different variables that could affect an entity's effective tax rate. I've seen ETRs that run to negative, for example, especially maybe when the company has a tax credit or where they have some, maybe from a tax credit instead of a tax expense, which could have been, caused by having some, different tax credits in that particular year. So you would have those instances where the ETR is not conventional. You could have ETRs that are significantly higher than 15%, or you can have ETRs that are significantly lower than 15%. So I would imagine that in the coming weeks and months, there will be a conversation around what exactly would mean effective tax rates, because this appears to put the powers of determining how much tax a company is to pay in the hands of the FIRS, and that sort of goes against the concept of self-assessment. So I feel like my personal opinion is that the tax authority should not have absolute unfettered powers in determining how much tax a business should pay. That should be strictly based on the law. Even though yes, this has not been introduced, but I struggle with that part of determining or adopting effective tax rates, especially because the tax authority may then have, too much control. That's how I say it. Especially if you look at the different variables, that go into determining what effective tax rate is. So, but this would potentially mean for businesses is that there will be, there will most likely be some addition or top-up tax for businesses to pay where the ETR is less than 15%. So there will most likely be additional tax obligations to ensure that businesses pay at least 15% ETR where the ETR is lower than this threshold. But it will be interesting to see how this plays out in the coming months. Like I mentioned, I am aware that there are conversations that are ongoing, and typically FIS will also issue circulars that sort of provide guidelines to taxpayers. But I expect this to be taken up and looked at critically in terms of operationalizing some aspects of this law. Okay, so continuing from that effective minimum tax conversation, so you have some sort of introduction that look to address controlled foreign corporation rules. Currently, in the provision in the current Companies Income Tax Act, there's a provision, I believe, in Section 9 of CITA that talks about deeming undistributed reserves as taxable income. So in Nigeria currently, where you have where a company distributes dividend in any particular year, that dividend in that year is compared to total profits, and if the dividend is higher than total profits, the dividend will be adopted as the base of tax for that particular year. And there's also this provision in the law, like I mentioned, that gives FIS powers to review the books of a company and see if it has undistributed reserves, that's such that where should those reserves be distributed, should those profits be distributed, it will not adversely affect the business. Now the question is, how do you also determine that? Now this has now been sort of modified to extend to foreign companies. So if you have foreign subsidiaries controlled by a Nigerian company, the profits of that foreign company may be treated as distributed and taxable in Nigeria. So a foreign subsidiary, so the Nigerian company is the parent, and then there's a subsidiary that is outside of Nigeria. That subsidiary has profits that have not been distributed. And then the law is saying that upon review, the tax authority can look at the profits of that foreign subsidiary controlled by the Nigerian company. And if it has undistributed profits, those profits could be deemed distributed and taxable in Nigeria to the extent that they could have been distributed without harming the business. And my worry here is, what is FRS's, or how qualified is the tax authority? What checks are going to be carried out? What review processes will be in place? And how reliably can you actually determine that distributing those profits will not harm the business, right? So there's a risk here in the sense that where the foreign subsidiary has undistributed profits, those profits could be deemed distributed and then taxed in Nigeria in the books of the Nigerian, sorry, on the, of the Nigerian parents. Mr. Sheyi is asking if they have powers to do that. Well, based on this law, it will mean so, because like I said, it's even before all of this. Currently, with Nigerian companies, there's a provision in CITA that allows FIRS to deem undistributed profits as distributed and then taxable, even though it is seldom activated. We've seen it happen on a number of occasions, but this extension now this provision is now extended to cover foreign subsidiaries of Nigerian companies. And the reason is not far-fetched. So the belief here is that businesses have tried to outsmart the tax authority in times past by shifting profits to other jurisdictions outside of Nigeria. So if you leave the profits here in Nigeria in the books of the Nigerian company, FIS can easily have access to it, and of course deem them distributed and taxable in Nigeria. But FIS is now saying, okay, if those profits have actually been moved to a foreign subsidiary, it would ordinarily mean that they are not within the purview of FIRS. But now this is what I meant to say, even where you have foreign subsidiary, because of course it's expected that with all of the transfer pricing, documentation, compliance requirements, you'll be expected, the Nigerian parent now will be expected to disclose, all of its subsidiaries and related parties, as well as disclose or declare the transactions it has with related parties in monetary terms. So the law has now been extended to say, even if you have foreign subsidiaries, the profit of those foreign subsidiaries will now be subjected to further scrutiny. And if it is, of course, I don't expect this to be just to be applied automatically. It will be triggered where there are maybe audits or reviews or some tax disputes, and it is established that perhaps it's an attempt to maybe shift profits to other jurisdictions outside of Nigeria. That's where those conversions will be happening, because the FIS needs to also prove, if I were a businessman, that would be my position. So you need to even prove to me that this is because I'm trying to shift profit, because it may just be business structuring to maximize returns. And you need to also then demonstrate that distributing those profits will not harm the business. So that is the idea behind it, is to sort of curb potential instances of profit shifting and maybe tax evasion if we are going to go all out. But the idea is basically to curb profit shifting. So where the non-resident subsidiary pays less than 15% effective tax in its own jurisdiction, the Nigerian parent must pay a top-up tax to also meet that 15% effective rate. So like I said, this is trying to prevent Nigerian companies from shifting profits to jurisdictions with low tax regimes, such that those undisputed profit that companies may have been potentially or deliberately shielding from the tax authorities, those profits may now be exposed to tax upon being deemed distributable or distributed. Okay, so quickly, capital allowance. I think I'm going to move a bit faster. So for capital allowance, of course, capital allowance typically is a company has made investments in qualifying capital expenditure, and the law allows that company to claw back some of the investment by way of capital allowance, which can be used to absorb taxable profits. Of course, currently we have initial allowance and annual allowance, and they are paid at different rates depending on the class of assets, buildings, motor vehicles, furniture and fittings and whatnot. So now there's a change in the manner that in which taxpayers are allowed to make capital allowance claims. First off is that the law has eliminated initial allowance. So initial allowance is what you claim in the first year of investing the asset and putting the asset to use. And it's usually, high compared to what you claim on an annual basis. So for example, motor vehicles, if you make an investment of 100 million, you can claim 50 million in the first year, which is 50% initial allowance, and then annual allowance of 25% on the balance. So in the first year, you can actually claim 62.5% and spread the balance of 37.5% over the next 3 years. So what it means now is that with the initial allowance no longer applicable, it means that in that first year, what the company can claim, the maximum the company can claim is 25%, for example. So instead of claiming 62.5% in the first year, that will now be reduced to a maximum of 25% because the company can no longer claim initial allowance. So it means there may be an exposure to tax in the first year of making those investments, because the capital allowance that the company can claim will actually now be reduced, and therefore that may mean higher taxes in that first year. This would also mean slower cost recovery because the capital allowance is not accelerated. It may mean tighter cash flow because companies may not have to part with a bit more cash tax, especially in the first year. It remains to be seen how this would affect businesses. Perhaps businesses may no longer, invest so much in assets if they don't see a clear benefit. And I should also add that this is in addition to um, the elimination of investment allowance in the finance act 2023, which meant companies, especially manufacturing companies, could get up to 110% when they invest in, plant and machinery and such equipment. So with this elimination of initial allowance, it means that the capital allowance available to be claimed by companies, especially in the first year, would be reduced, and capital allowance would not be accelerated. So there's minimum tax. Minimum tax I mentioned earlier, which was levied or is currently levied at 0.5% of gross turnover, and it's only applicable where a company has no tax payable in any year, or where the tax the company would have paid based on normal assessment and total profits is less than minimum tax. Minimum tax is an anti-avoidance provision because if you recall, before now, um, foreign companies, for example, meaning Nigerian companies with at least 25% imported equity, were exempt from minimum tax. Of course, companies within the first 4 years, small companies earning less than 25 million, companies engaged in primary agricultural production, at some point, those were you amended. But now, minimum tax has been completely eliminated. And I think it's a good one for companies because where you don't have total profits, you don't have taxable profits, then you are not going to pay any tax. Because even before the minimum tax was redesigned to focus on revenue, it used to be on capital assets. It was a percentage of net assets, paid up share capital, gross profit and revenue. So it was a struggle to make sense of why a company had to pay tax on its capital assets where it had no total profit or it had no tax payable. So that was amended to focus on gross revenue, but now it's been completely taken out. So it means that where a business or a company doesn't have, tax liability in any year, it means that largely from the fact that it's not generating sufficient taxable profit, it should not pay any minimum tax, and it sure will not be made to pay tax on its assets. Now, free trade zones, economic zones, export processing zones, the idea was to encourage exports, make, companies manufacture and sell outside of Nigeria to export outside of Nigeria. And in return, free trade zone enterprises were given some sort of tax relief and exemption from all tax obligations. Now, but the idea behind the primary objective of establishing free trade zones was to encourage exports. But what we have seen in practice really is that some free trade zone companies have actually in practice been selling to the customs territory, and which is against the original objective of encouraging exports. And I am also aware that in practice, some companies have been able to get away with that, meaning they sell to the customs territory rather than exporting, and they also do not pay tax. Now, the law recognizes that fact and has put a cap of 75% exports. So if you're a free trade enterprise, you would only enjoy full exemption if you export at least 75% of your sales, or you use that for input into exported goods or goods to be exported. Now, the law still gives a provision, a leeway to sell no more than 25% to the customs territory in a given year. But where a company, sells more than 25% to the customs territory, then those sales, the profits from those sales will not be taxable, meaning liable to income tax and all other taxes as may be applicable. Now, this is the phase development because from 2028 January, it's now expected that whatever sale you make to the customs territory will be fully taxable. So whether it's 1%, whether it's 2%, whether it's 24%, once you make sales to the customs territory instead of exporting, profits from those sales will be able to tax in Nigeria, unless, of course, there's some presidential order for that. But the idea really is to go back to the original intention of establishing free trade zones, which is to encourage exports and, help Nigeria realize foreign currency rather than selling back into the customs territory. So for businesses generally operating in the free trade zone, the expectation is that they would, refocus their strategy to align with the original objective of establishing free trade zones, which is to, make more of export sales. Okay, so there's the economic development incentive, which is more or less a direct substitution for, what we used to know as the pioneer status incentive. Pioneer status incentive is a tax holiday scheme that grants, exemption from taxes, from income tax to companies that qualified, that have made an application to the NIPC, Investment Promotion Commission, and upon making that presentation and making a case in terms of what businesses the company or what business the company wants to go into, what products or services it hopes to render, upon approval by the NIPC, of course, the company would then be exempt from income tax, first for a period of 3 years, which can be extended for up to another 2 years. So in total, it was possible to get that exempt or to enjoy that exemption for 5 years. And of course, it was specific to industries, sectors, goods, services, and other products. Now we have the economic development incentive, which will be restricted to what are known as some priority sectors. So it's those priority sectors that will be eligible for tax credits. The idea behind it is giving this incentive is expected to stimulate, growth in those sectors and then help them to, to grow and blossom, which was also the objective with the pioneer status incentive, because like I said, it was not every industry. So the PSI was restricted to certain industries, certain products, certain activities, certain services. And that has now been, imported into the EDI, Economic Development Incentive, such that only priority sectors are, eligible for the tax credits, including aquaculture, refined petroleum products, electronic motors, aircraft, and whatnot. And the idea really is to, encourage investments in this space, and see them blossom. So upon qualification, and a business in the priority sector can get, up to 5% credits on qualifying capital expenditure, and that can happen for up to 5 years. But of course, they will still be assessed on to normal taxes that the company should pay. But there will be a sort of relief by way of tax credit on qualifying capital expenditure that have been incurred. And then where there are unused credits, as a result of maybe not having sufficient profits in any particular year, those unused credits forward for another 5 years. Capital gains tax. Okay, so capital gains tax currently is levied at 10% of chargeable gains, meaning gains less the cost of the asset and necessary cost to sell that asset. Even if I don't think there's any express sentence in the Nigeria Tax Act that says it is now 30%, but what it has basically done is to equalize, trading profits and capital gains. So instead of having capital gains subjected to a different tax regime and taxed at 10%, and then trading profits assessed to tax at 30%, what is now required, what's now expected with this introduction is that whether trading profits or capital gains, everything will be consolidated and then taxed at 30%. So if you have trading profits of 100, after doing your normal, amendments and adjustments based on the tax laws, and then you have capital gains of 70, you don't treat the capital gains separately and then trading income separately. So you consolidate the trading profit of 100 and the capital gains of 70 and pay tax, at 30%. So it closes the gap between capital gains and trading income taxation, which was 10% and 30%. But then one of the drawbacks may be increase in transaction costs. It may also discourage disposal because, I mean, if I were to dispose and ordinarily was supposed to pay tax at 10%, but now the government is asking me to, include my capital gains in my trading profits and pay tax on it at 30%, perhaps that may have a way of discouraging disposals, mergers, and similar investment because of the clear increase in tax rate from 10% to 20% for CGT. Again, the government is trying to close loopholes and ensure that people don't take unfair advantage of the tax laws, which is why the equalization is happening. But I mean, we'll see how that plays out in the coming months. Compensation for and damages exemption from CGT. So the threshold, what this has done is to basically increase the threshold. It used to be 10 million. So where an individual receives compensation and damages exceeding 10 million, it is the excess of 10 million that will be liable to capital gains tax. But the threshold has been increased from 10 million to 50 million. Meaning if the damages or the commission received is less than 50 million, there will be no CGT. But where the compensation or the damages received, exceeds 50 million, the excess will be liable to CGT. So if you look at this now compared to the increase in capital gains tax from 10% to 30%, you also see a corresponding increase in threshold, meaning, if you look at it, you can say it's a win-win in quotes, because on the one hand, the rate for CGT has gone up. On the other hand, the threshold for being eligible or for gains or damages or commission to be liable to CGT has also now increased, from 10 million to 50 million. So it means that less people will be caught in the net for CGT purposes based on this, but then the rates would now increase. So as you're making more money from compensation and damages, you are paying more tax. So it sort of tries to balance out that. For mergers and acquisitions, so what used to happen in the past is that when there's a merger and acquisition and the creation of a new company, that new company will be deemed to have commenced a new business, on the day following the merger. And in practice, this has created, challenges and disputes with the FRS in times past, especially when it came to, things like enjoying tax assets. So things like capital allowances, things like tax losses, things like unutilized withholding tax credits that ordinarily should be, transferred or transferable to the surviving entity. We've had instances where FRS has vehemently refused to grant those tax credits to the surviving entity for reasons best known to them. And then back then, even before the amendment by the Finance Act 2019, once there's a merger or there's a restructuring, whatever surviving entity would, evolve from that restructuring will be deemed to be a new company, will be deemed to have commenced a new business, and would have had to apply what we know as a commencement rule, which was applicable to the first 3 years. So that commencement rule was bad news for businesses because there was a clear duplication of business period and multiple taxation on the same profits more than once. So it wasn't good news. But then the law was amended via Finance Act 2019, where the entire framework of commencement rule was abolished, and that effect of multiple taxation was eliminated as well. But this has now been clearly refined to say that when there's a merger or restructuring arising from a business restructuring, the surviving entity will not be deemed to have commenced a new business. Cessation rules will not apply. Commencement rule will, of course, no longer apply. Chargeable gains will also not apply to the assets transferred during the merger. Now, in the existing Capital Gains Tax Act and the Value Added Tax Act, value added tax may apply to assets transferred during mergers. Capital gains tax may apply to assets during mergers, but there are conditions. So one of those conditions is that relationship, meaning the two entities involved in the restructuring of the merger or the transfer must have been related at least 365 days before before the date of the restructuring, and must remain related 365 days after the date of restructuring. Now, beyond that, there's also the disposal test, meaning those assets transferred in the course of the restructuring must not be further disposed by the recipient of those assets until at least 365 days after the restructuring. Where those two conditions were not met, CGT would apply if they are capital gains, and then VAT would also apply. But where those conditions are met, which is what we know as the 365-day rule, then CGT and VAT would okay, I want to please move quickly. Okay, for stamp duties, stamp duties is, I've not met any consultant who enjoys talking about stamp duties. In my 11 years of tax consulting, I've not met any, not even lawyers for that matter. Because the feeling is that the law is a bit archaic, and it needs a total overhaul, or it needed a total overhaul, which has now sort of happened with the Nigeria Tax Act. So it attempts to bring some clarity in terms of what instruments are liable and who is responsible for stamping those instruments. So, for example, you see in the Stamp Duties Act, in the current Stamp Duties Act, there's no clear indication of whose duty or whose responsibility it is to stamp a particular instrument. The only indication it gives is that the person who is liable to penalties for non-stamping is the customer. So, if you have a lender and a borrower arrangement, for example, the expectation is that it is the borrower who's required to or expected to stamp those instruments. So, but it wasn't clear cut to say you have the responsibility. It just says the person that will bear the penalty is the same as the person that was supposed to stamp. But then again gives examples of the lender and the borrower, and say it's the borrower that will be responsible for bearing penalties for non-stamping. So the NTA has tried to make certain clarifications by detailing what instruments are liable, who's responsible for stamping, and take out some of the ambiguities and overlapping provisions that have caused disputes in the past. Okay, so for Personal Income Tax Act, I think this is where, if you talk to maybe friends, colleagues, family, of course, this is the one that really concerns them. So because it affects them directly. The news is that there's a change in how personal income tax will be computed. There used to be, or there's still, the graduated tax table. First 800,000 exempt. It used to be first 300,000 at 7%, next 300,000 at 11%, and all of that. So there are new bands and new rates. One of the key things is that 800,000 income, or persons earning 800,000 annual income will not be required to pay income tax. Yes, personal income tax on their earnings as individuals. And then you have the next 2.2 million at 15%, all the way up to 25% for people earning above 50 million annually. These are annual amounts, by the way. Now, what this means is that for individuals that are earning that are the low income level, it will reduce in lower tax liabilities for them, and which will also mean increase in their disposable income. But for individuals that are, somewhere around the upper echelon in terms of higher income brackets, it means that the income would also be subjected to increased personal income tax act. So this is more or less what's that tax system? Like a proportional tax system where low income earners pay low tax and then high income earners pay higher taxes. So in a way, this is like my 10,000 foot view of the changes, especially as it affects personal income tax acts. There's also a provision that talks about the employment of a non-resident employee and the treatment of their income. So if such an employer is in the startup or technology space, and of course creative arts, the employment income would not be taxable in Nigeria. So it means you have a non-resident employee working for a Nigerian company that's engaged in, there's a startup, is engaged in technology services or creative arts. The non-resident employee would have his income exempt from tax in Nigeria if the employer is a startup engaged in technology or creative arts, and the employment income of that employee is taxable in his home country. So if the employee is resident in Rwanda, for example, and the Nigerian employer is a startup engaged in technology or creative arts, the employment income of that employee is not liable to tax in Nigeria, provided that these two conditions are met, one of which is that the employment income is taxable wherever that employee is resident, say Rwanda, for example. So this means for tech startups and creative arts industries, it will make it a bit more attractive in terms of less tax burden, less compliance obligation, and of course, the check to ensure that the employment income is also taxable in the home country also means that there will be avoidance of of double taxation or multiple taxation, as the case may be. So for reliefs, for CRA, which is the Consolidated Relief Allowance, which used to be, or which is currently, I keep saying used to, which is currently 21% of your gross income, or 20% and of your gross income plus 200,000, whichever is higher. That used to be or that is currently the CRA that employees enjoy as relief from their total income. Now, there's a new introduction of a rent relief for 500,000 or 20% of annual rent paid, whichever is lower. And of course, before claiming this, this incentive or deduction, it is required that taxpayers will write to the relevant tax authority, in this case, state tax authorities, before claiming any deduction. Now, for me, this is way lower than what you would ordinarily expect, with CRA, because, 500,000 naira, compared to 20% of gross that we used to have, would most likely be lower, and 20% of annual rent paid. Again, if for people that are in the low to income to middle income brackets, this will not amount to much in terms of relief. But then the requirement to also write to the tax authority before claiming an deduction. I would imagine that for people in paid employment, this would be done by the employer on behalf of the employees. But I think this is just some unnecessary typism and administrative bottleneck, but again, it will be interesting to see how that plays out in the coming months, so that the approval process is not made overly burdensome for taxpayers. For VAT, there's a new rating on essential goods and services, which is listed as zero rated, meaning VAT will apply at 0%. And you have some of these items as basic food items, pharmaceuticals, medical equipment, educational materials. Now, these items used to be exempt from VAT, but now they are being classified as zero rated. The difference or the major difference between exempt and zero rated is that for zero rated supplies, the supplier can claim impute VAT. So if I make a supply that is deemed to be zero rated, I'm going to put VAT but at 0%. But if I incur impute VAT in making that supply, what I'm selling to my customer, I can actually claw back the impute VAT from that output of zero. But what it will mean is that there's a high chance that I will be in a credit position because I would have incurred impute VAT, but I am not charging output VAT, or I'm charging output VAT at zero. So depending on the variety in my supplies, I may have a net credit position, after which the law then provides that I should maybe what's the word, engage or walk up to the FRS and get some credits. But the interesting thing is that these items have been moved from exempt services or goods to zero rated goods and services. Now, on impute VAT, what we have currently is that what is known as allowable impute VAT, meaning the impute VAT you can claim against output VAT, is restricted to goods that you bought to resell, raw materials and other stock in trade that you use in making a new product that you charge output VAT on. But the impute VAT mechanism has now been redesigned in a way that allows claim of impute VAT on all purchases, including services and fixed assets. Of course, for fixed assets, it will be impute VAT will be capitalized along with the assets, while for services, it would before now be expensed to the income statement. But now the law would allow impute VAT on all purchases, including those on services that were previously expensed to the income statement and those on fixed assets that were capitalized with the cost of the assets, meaning companies can now recover impute VAT. But the only condition is that impute VAT must be directly related to supplies that are also subject to VAT. So you've incurred impute VAT to make a supply that you're also charging VAT on. So as you are collecting output VAT from your customers, you can then recover or claim the impute VAT that you paid to suppliers. So this would favor a lot of service companies because the claim of impute VAT used to be enjoyed by manufacturers and traders, but service companies were not getting this benefit because they had to expense their impute VAT to their income statement. But now they will be allowed to also enjoy claim of impute VAT just like their counterparts in manufacturing and trading. I think we're almost done. Please bear with me. So fiscalization for VAT filing and collection, there's the e-invoicing system that has now been introduced, by the tax authority to sort of automate revenue monitoring, invoicing, and of course, ultimately VAT compliance and reporting. Now, I should mention that this is not the first time that this has been deployed or attempted. Sometime in 2014, the FIS had tried to deploy a third-party software to the ERPs of banks, just to monitor online transactions in real time. At some point again in 2019, 2020, thereabouts, they went after retail stores, supermarkets to also deploy what they call VAT track to sort of, monitor and record sales online and real time, so as to, simulate how much VAT those businesses were required to pay. But some of the pushbacks we have had in the past have been things around data integrity, the risk of data theft, the risk of data getting to the wrong hands, the risk of incompatibility, the potential risk of disrupting businesses, and corrupting data and maybe even shutting down the entire ERP system and leading to, loss of revenue and sales. So with e-invoicing, FIS is partnering with a lot of some technology companies, and the requirement is that taxpayers are required to register and onboard on the platform such that invoices would only be issued using that platform. There will be no duplicate, and the FIS can see at a glance what invoices are issued and they can then use that to, monitor revenue reported by those companies vis-a-vis what goes into their financial statements, what is in their bank statements, and the invoices they are issuing. So it's a way of monitoring, strictly compliance, but there are also concerns around whether it's legal to actually do that, whether it's legitimate to do that, and what risks that will be posed in terms of, data integrity and the risk of data theft and all of those. I know conversations are ongoing currently. FIS is trying to do a lot of stakeholder engagements and engaging, starting with the large taxpayers to get them to onboard on the platform. But I mean, it's an interesting conversation, and this will, unfold in the coming days, and how all of this will play out. So, quick summary that I've tried to put up in terms of the changes for Companies Income Tax Act, the categorization of small companies based on turnover threshold, less than or equal to 50 million with asset base of less than 50 million, no tax. Anything above 50 million, taxed at 30%, no more medium-sized company categorization. For personal income tax acts, or for personal income tax rather, individuals earning 800,000 or less will be exempt. Higher earners will now, have to deal with a marginal increase all the way up to 25%, which is the highest rate for the highest band. For withholding tax regulations, of course, this was first introduced in July 2024, and then the Gazette was issued in October 2024, and then with requirement to take effect in January 2025, which has now also taken effect. And then we've seen a revision to the withholding tax rates moving between 2% and 20%, depending on the type of transaction. Capital gains tax implicitly increased from 10% to 30% because you have to now, aggregate capital gains with profits from trading income and tax everything at 30%. VAT is retained at 7.5% on supply of goods. There were rumors that it was going to be increased to 10%, but it's been kept at 7% for now, perhaps. But I expect that in the nearest future, there'll be conversations around fees increase like the bill had it. Okay, so for tax administration, I mentioned the binding of FIS at NRS, now taxed with the responsibility of collecting more or less, all taxes due to the government coffers. There's also a VAT distribution formula, which increases allocations to local government, federal government shares reduced from 15 to 10%, and then state governments will get, 55, and local governments will now get 35, and hopefully it will it will bring the government closer to the people, as it is said in theory. I'm not sure how well that plays out in practice anyways, but that's a matter for another day. For tax disputes and penalties, there's the introduction of the tax ombudsman, which, is an independent body that is responsible for, investigating tax complaints, tax disputes, with an aim to, to protecting taxpayer rights. And of course, serving on the ombudsman in the ombudsman office will be enabled for, after a 4-year term. This is, so I think of this as a quick way to resolve tax disputes rather than perhaps the, often relatively longer route of going to the tribunal or going to the courts, So this is like, I know the FIS also tries to do this with their tax policy and advisory department, where you can, write to FIS to request a private ruling on a particular tax issue. So I expect this to borrow from that and to try to also combine with some of the processes of the tribunal, which will, transparently mediate when there are tax disputes, make recommendations, so that tax disputes can be quickly resolved, and with focus on protecting, the interests of the taxpayer. So those are the key changes that I felt were what, looking at in this session. I know I've taken longer than the time allocated. Chinyere, my apologies. So those are the quick what I consider to be the key changes. I am aware that there may be other questions, or maybe there are some parts of the bill that, or the acts rather, that may interest you. I mean, the Nigeria Tax Act is about 214 pages, for example. So it will be a challenge to fit everything into a 1 hour presentation. But those are the things I consider key. Of course, we can have comments or questions around perhaps some other areas, and then we can exchange ideas and drive home the points. Thank you very much for your time. Thank you for the opportunity. Back to you, Chinyere.
Thank you so much, Vincent. This is a masterclass. Very insightful session. I'm not sure we could have. I mean, I didn't have enough. I couldn't have enough. I saw the time going, but I couldn't. Interject because every single point was super valuable. You're able to break it down in a way that we could digest. I'll speak for myself. So between now and 11:25, we'll be taking questions. Please, if you have questions, go ahead, drop it on the chat box, put up your hands. Very insightful presentation. I see a question there from Christopher. Good morning, Vincent. Just a second. Thank you for the presentation. Could you shed more light on the stamp duty tax?
Okay, so stamp duties. I'm trying to explain this like a layman, because this is a matter that sort of should interest lawyers, but even lawyers don't get interested by stamp duties. So the stamp duty is saying stamp duty typically has what is known as dutiable instruments. Things like agreements, any enforceable contracts, legal documents, and whatnot. Now, the requirements is that those documents, those instruments, those enforceable documents, those agreements, those contracts are to be stamped, of course, with there's a commissioner for stamp duties, but stamp duties are collected by FIS as well. Depending on the categorization of the transaction, the contract, the agreement, or the document, as the case may be, there are different rates at which those instruments or those documents are to be stamped. And stamping a document makes it enforceable or tenable in court. So, for example, you have what is called a loan capital. Loan capital is basically a loan agreement between two parties. So there's a document, there's an agreement for party A to lend party B some money, for example. Now, like I said, there are different categories, there are different variables that would determine at what rate a document should be stamped. So if I enter into a loan agreement with you, sir, Mr. Christopher Ogba, a loan agreement, so there's also what you know as an omnibus agreement, a general or a generic agreement that doesn't relate to any specific thing. So if I enter into a loan agreement with you to say, okay, you are going to give me a loan, and the loan is for, let's say, 6 months, short term, 6 months, for me to just maybe make a purchase, and then I will repay you within 6 months. There's a way you would treat that loan agreement for stamp duty purpose. Now, I could enter into another agreement with Mr. Sheyi, sorry. And then the repayment period is, say, 3 years. And I needed the loan to purchase some heavy machinery or equipment. Those two agreements, even though they are both for me to take a loan from the lender, for stamp duty purpose, they are seen as different instruments. In the first instance, the loan for 6 months for just for a temporary period is seen as a loan agreement. The other agreement with Mr. Sheyi, for example, that is for 3 years for purchasing the machinery, is seen as loan capital. So, oh, sorry, my apologies. I've been referring to Sheyi as Mr. I'm thinking I got that wrong. I'm so sorry if I got that wrong. Apologies. So for the loan agreement, which is short term, the stamp duty rate is 15 kobo based on the current Stamp Duty Act. But in the case of the loan capital, because the loan is longer term, I'm repaying within 3 years instead of less than 12 months. I didn't take the loan for a temporary reason. I took it to buy a machine that is essential to my business. That will be classified as loan capital, and I will be required to pay stamp duty at 0.125% of the loan amount. So imagine paying 0.125% of, say, $1 million versus just paying 15 kobo because it's a generic or an omnibus agreement. So there's the loan agreement and there's loan capital. And these are the fine details that may not be very obvious, on the surface. I mean, it's a whole lot to unpack, but generally speaking, stamp duties would apply where they are what you call dutiable instruments, things like contracts, agreements, loan capital, basically any document that is tenable in court and that supports a transaction by way of maybe contract or agreements. That is typically what stamp duty would cover. I think someone asked a question about VAT for free zone enterprises. Yes. So now the NTA, will free zone enterprises continue to enjoy VAT exemption on their purchases, regardless of their revenue sources? When you say revenue sources, you mean whether they sell to the customs territory or whether they export based on this 75%, 25%. Now, so currently, like I said, the objective is to, okay, thanks for that confirmation. The objective is to encourage exports. Even before the NTA, if you make a sale and the sale is deemed to have taken place in the customs territory, don't forget that this is the free zone enterprise that is enjoying the VAT exemption, not the customer. Because so if a customer goes into the free zone currently, a customer goes to the free zone and purchases products, as is exiting the free zone and entering into the customs territory, at the point of exit, that customer is going to pay VAT to customs because customs is at that exit and entry point demanding VAT and all other taxes as may be applicable. So at that point, the customer now exiting the zone and entering into the customs territory will be required to pay VAT to the customs at that exit entry point. Now, in practice, even though free zone enterprises are exempt from tax obligations, meaning they shouldn't even include VAT, customs should just, engage the customer and make the customer pay the VAT. But I am aware that in practice, free zone enterprises actually put VAT on their invoices to customers. They claim input on purchases, and they actually remit VAT to the FRS, which is not supposed to be so. But I know that happens in practice. So when a free zone enterprise purchases its goods, expectedly from imports, it won't pay VAT. But of course, there are guidelines around the goods being escorted by NEBSA officials and custom officials, ensuring that those goods are properly tagged and they're actually used in the free zone. And that is also a way to try and curb illegality, to ensure that people don't take advantage and purchase goods through free zone enterprises and then find a way to smuggle them out to the customs services and use in making production. So there's a mechanism in place to ensure that those goods are actually correctly tagged. They're escorted by NEBSA and customs officials to ensure that they are used in the free zone that we originally meant for. Now, so as far as that is concerned, they won't have to, bear input VAT and custom duties when they import into the zone. Now, for their sale, if you sell to the custom territory, like I said, even though you are exempt from all tax obligations based on the NEBSA Act, the customer is still required to pay the VAT at the point of exiting the free zone. Now, it also depends on where we agree to be the place of supply. If the free zone enterprise leaves the zone and goes into the customs territory to make a supply, then of course there will be VAT, regardless of the revenue source or whether it's 25% or 70%. The 25% and 75% actually talk about income tax. The focus with that is on income tax. So if you export 75% and you sell not more than 25% to the customs territory, you will still be exempt from income tax. But it's also important to distinguish between where that supply is happening. If the FZD leaves the zone to make that supply in the customs territory, the FZD will be required to account for VAT because it's taxable. Yeah. Now, if the FZD remains in the zone and the customer comes into the zone to make that purchase, even though the FZD, in that instance, the FZD has no obligation to account for that because it's playing well within the zone. The customer is still required to pay the VAT at the point of exiting the free zone into the customs territory. So to summarize, the revenue source ratio affects income tax, not VAT. VAT will still be determined based on the place of supply. I don't know if that managed to answer your question, ma'am. Okay. I see your question. You are asking as a vendor to FZD companies.
A vendor, yeah.
Should you continue to exempt them from VAT, your invoices? Okay, so you are a vendor, so you are providing services or making supplies to the FZD. Now, great. Again, it goes back to the place of supply. There's this notion that FZDs are considered non-residents. So the way and the NEBSA Act also provides that when you make a supply to an FZD enterprise, it is deemed to be an export. So the same way you make exported sales or provide exported services that are not liable to VAT is the same way a supply to an FZD would be exempt from VAT because the rules applying to export also apply. But you need to determine where title and ownership passes. But generally speaking, if you are the vendor and you are providing services or sales to the FZD, to an FZD, VAT should not be applicable. But in the case of services, there's no issue because service is intangible. So you are providing services to an FZD enterprise, no VAT. But in the case of goods, when you're supplying goods, for it not to be liable to VAT, the goods must be deemed to have been supplied in the zone, meaning you have to take the goods to the zone, not the FZD coming into the customs territory to pick up those goods. So that is where the place of supply, that is where it comes in. So for service, no issues because it's intangible, no VAT. For goods, if you take the goods to the zone, the goods will be deemed to be supplied in the zone, no VAT. But if the FZD comes into the customs territory to pick up those goods, then there will be VAT exposure.
Thank you so much, Vincent. Hope that answers your question. We'll take the final question since we are running out of time. Thank you for the summary thus far on the new tax reform. Please give better clarity on the upcoming invoicing tax policy in line with FIRS and state what concerns the company should start doing.
Okay. I don't know where your company would fall in terms of categorization for tax, whether large tax office or not. But what I can tell you is that FIS has had a number of stakeholder sessions to try to sensitize taxpayers on the new developments of the e-invoicing. Like I said, the invoicing approach is a mechanism to monitor sales recorded by businesses. So basically saying for all your transactions, for all sales, for all supplies to your customers, you should only invoice on this platform. So, and there's also a counter check on the other hand. Think of it like withholding tax credits. You know how Company A has provided services to Company B. Company B has deducted withholding tax when it was paying Company A and has remitted the withholding tax on behalf of Company A. So Company A is entitled to withholding tax credits based on the remittance made by Company B. If Company B does not make that remittance, then Company A would not get withholding tax credits. But with the new regulation, of course, we now have it where once company B has deducted, it should issue a receipt to Company A, and then Company A can get that claim credit whether or not Company B has actually remitted. So, and you know, there was also a time when the FIS chairman then the FIS had tried to, you know, what's the word? Copy that mechanism of remittance or payment with VAT, where there was that introduction that a company could only claim impute VAT on purchases to the extent that the supplier who collected the impute VAT from the customer has also remitted. So it was like punishing customers for the defaults by the supplier. But of course, that has since changed. So the point here is that if a company it has provided services to a company A has provided services to customer B, it should only issue invoices using this soon to be introduced platform or this new platform. Now, there's a counter check and balance there where FIS can see at a glance invoices that have been issued by Company A to Company B. So in terms of assessing Company A to tax, for example, FIS can see the revenue, FIS can assess the company to VAT, FIS can assess Company A to income tax, for example. Now, going back to Company B, FIS can also see who that invoice was addressed to. So Company B received this service. Now, FIS can then go after Company B in terms of withholding tax. So FIS does not even need to go after both companies separately. FIS can actually sit in its office and see all the transactions online real time. So it means that FIS will have more or less the information it needs to go after all companies, whether the service provider or the customer who's receiving those services. Okay, Suleiman, thank you. I see your hand up. I guess you want to maybe add a few more comments to that.
Yeah, we have here one of the Andersen partners, Suleiman. Over to you. Yeah.
No, good morning, everyone. No, I think it's a bit unrelated, Vincent, so you can finish your thoughts.
Oh, okay, great. So that's it in a nutshell. The idea is to have FIS view transactions from the comfort of its office and to have information on transactions as they are happening. When FIS comes for an audit currently, so they ask you for a long list of documents, you provide your financial statements, you provide your trial balance, you provide your general ledgers, you provide your bank statements, you provide your invoices, you provide a ton of documents. And then FIS tries to draw a relationship between your sales invoices, your receivables, your bank statements, your revenue in the financial statements, your revenue by the VAT forms you filed. So they can have up to like 4 or 5 different bases trying to determine what the actual revenue of a company is. They go into your bank statements, pick all your credit entries, all the inflows, and say, oh, you have revenue of 20 billion, but I can see that you only reported revenue of 5 billion. You have undisclosed income of 15 billion, which is usually not the case. So I feel like this would also help to reduce those or eliminate those instances of ambiguities and duplicates in terms of alleging that the company has unreported income. Now, so once the expectation is met, which is to only issue invoices using the invoicing platform, FIS may not need to go after Company A to get their records in terms of revenue. FIS may also not need to go after Company B, to get an idea of the expenses they incurred on which they should have deducted withholding taxes. So FIS can see that at a glance, from the platform, and it can draw a relationship between the activities of company A, the supplier, and that of company B, the customer. But of course, there are concerns around things like data integrity, data theft, getting into the wrong hands, how it will the risk of it affecting businesses or ERPs, causing disruptions and all of those things. I want to also believe that those issues will be addressed as FIS continues to engage key stakeholders on this. Thank you.
Thank you, Vincent. Suleiman, over to you.
Okay, thank you so much, and good morning, everyone. My name is Suleiman, and I work with Vincent, at Andersen. So I just wanted to add to what Vincent has already said, to say, these changes that we're seeing are very comprehensive. He just mentioned that the Nigerian Tax Act, for instance, it's over 200 pages, and what he has just done is to just highlight some of the things that he considered are important changes. Obviously, there will be a lot more, so I just wanted to add here that I think when you have big changes of this magnitude, what, might be useful to consider is to look at how it will impact individual businesses. Obviously, it will affect companies not in the same manner. Each of these provisions might affect companies in different manners. So as finance professionals, what will be useful is for us to do maybe some kind of proactive impact assessment. If
Is it just me? I can't hear Suleiman anymore.
I think we lost him. Maybe let's just give him a minute to come back.
Okay.
Oh, okay.
Yeah.
Can you hear me now?
Yes.
Oh, okay. Apologies about that. So the point I was making is to say, that as finance professionals, we need to be proactive, in our approach in determining how all of these changes will affect our individual companies. And that, needs to happen before the full implementation, so that if you know exactly how it's going to impact you, whether negatively or positively, you can then plan around, how you respond to those changes on a going forward basis. Whether these changes are going to lead to more tax costs for the business or for the employees, how do you manage the employees who may pay additional taxes? What will it mean for budgeting? And it holds a lot of other areas to look at. And I think as finance people, that would be a great value that we can add to our businesses and our companies where we work. And that is an area where, we can partner with you. Vincent can drop our contact numbers should you want to engage, subsequently. We're happy to partner with you in that regard. But thank you so much for having us in your midst, and we look forward to engaging a lot more. Thank you.
Thank you so much, Suleiman. I dropped the email addresses. You could do phone numbers as well. Thanks so much for this very, very impactful session. Vincent, I've gotten chats about you share. Everyone's saying, hope we can get the slides. We hope we can. But because our time is fast spent, I'll be handing over to the lead of. So this webinar is powered by the Career Development Group of the ACCA Women's Network. And our lead is Mrs. Sheyi Willoughby, and I'll be handing over to her to give us her closing remarks. Thank you. Thank you, everyone, for your time. Over.
Thank you, Chinyere, for the excellent moderation. Well done, very well done, and for assisting to put this together. On behalf of the ACCA Women's Network, I'm going to say a very big thank you to Andersen, to Vincent, and Suleiman. Thank you so much for such an impactful session, Vincent. It's been so insightful. I've seen comments on our group 1.5 hours very well spent, you know. So it's been a great learning session for us, and we've taken several points and impacts. And like Suleiman said, this is what impacts our business. So perhaps a proper impact analysis for all the respective businesses and the roles that we all play in our respective organizations is something that we may need to do so that we can function better. What we typically do here within the career development is to try and bring up topical issues in training and how it impacts our business, because our focus is to ensure that all our women, all our ladies, you know, excel, you know, in their respective roles. So today's session is one big one that I know a lot of people have taken several pointers and learning points away from that they can continue to implement in their respective roles. So it's broadened our understanding and, you know, and how we continue to navigate the new tax reforms as it comes into force next year. So thank you so much, Vincent, Suleiman, and the entire Andersen team. And I hope that would also be engaging Andersen. They're one of the big tax consultants. Should the need be in partnering with them, you know, in our respective organizations. So the contact address, email addresses and phone numbers are available. And you can always reach out to Chinyere or myself should you want to speak to them. Thank you so much and have a good afternoon. So you can go and enjoy your Owambe Saturday today. Thank you so much, Vincent.
Thank you so much for having us. Thank you very much.
Yeah.
Bye.
Bye.
Thank you. Bye.
Thank you.